Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello, and thank you for joining us on this week's edition of our Through the Noise podcast. Naturally, it's been a challenging week for investors overall, with equities down around 3% and bonds down around 1%, with the sell-off pretty much broad-based. Commodities rallied, once again led by oil prices, and the dollar strengthened about 1%. From a Standard Chartered CIO office perspective, our Global Investment Committee met this week, with the main change being to our US interest rate forecast, where we now expect 3 rate hikes this year, still slightly below market consensus. The reasons for the increased expectation when it comes to interest rates from our side are threefold. Firstly, the Fed's hawkish turn in light of a tighter than expected US job market and persistent inflation. Secondly, Omicron has been prolonging supply chain bottlenecks, particularly in China, where they are now, for now at least, sticking with their zero COVID stance. And also COVID is keeping away workers from job markets longer than we expected. And the third point is we have obviously seen a significant rise in oil prices. Today's podcast will focus on the implications of this change in interest rate view for our investment views, as well as going through some of the key client questions we've had during our 2022 Outlook webinars around the world. We will cover topics such as global equities and China equities, implications for our bond market preferences, and also our currency market outlook, as well as a brief discussion of the metaverse and cryptocurrencies. To do this, I have with me today Daniel Lam in Hong Kong, who runs our equity strategy team, and Abhilash Narayan in Singapore, who is a senior member of our bond strategy division. Just a quick warning to the listener, this podcast will run a little longer than normal as we have a lot to cover. Thank you, gentlemen, for joining me this morning. Let's start with the most obvious topic of conversation, US interest rates and inflation. So as I mentioned, Daniel, a lot of clients, when we're doing our virtual roadshow, have been indicating their concern that rising interest rates, high valuations, and new virus mutations are a pretty toxic mix when it comes to the equity market outlook. How do you square this background with a bullish equity market outlook?
Thanks, Steve. We must remember that the Fed is normalizing its policy because it has confidence on the ongoing global growth recovery. And we don't see that the policy rates are turning restrictive enough in both US or Euro area, which are our two preferred equity markets. And we think that most of the policy tightening expectations have already been baked into the markets. And basically, if you look deeper, for the Fed to over-tighten its policies, that's a very low probability because we think that growth is going to slow in the coming quarters. They're still above trend, but going to slow. And inflation, we think it's going to peak because A, you have capex boosting capacity, and B, you have business restocking. So all these factors means that, concerns that is going on in the market, we think is being overblown. And if you look at add that into corporate earnings outlook, which is still looking good, and also China easing policies, and that means that investors should really be buying the dips in equities.
Okay, so that's the sort of central scenario that we have from an equity market perspective. Clients have been basically waiting for a long time now, for 21 months, for a pullback, and now we've got it, looking a little bit nervous about the situation. What's the probability that we're wrong and that global equities experience a bear market in 2022?
Well, we think the probability is low at this moment in time, because if you look at the definition of a bear market, which is a larger than 20% correction, those almost always tend to occur when the US is near economic recession, which we do not see. Like we said before, economic growth appears to be slowing, but it's slowing from a very, very high level. Policies is getting more restrictive, but it's still at a very loose level. And also traditional recession indicators like the US yield curve are not flashing red. But we do believe that 2022, we're going to see more volatility ahead. Because of the mix that we talked about before. We could see relatively large pullbacks. So, for example, since 2009, the S&P 500 index seen 6 pullbacks of greater than 10%. But of course, as we all know, with the benefit of hindsight, the best decision when those happen is to buy on dips.
Okay, thanks, Daniel. Let's move on to bonds. So, Abhilash, what do tapering, higher interest rates, and reduced central bank balance sheets mean for bond investors going forward?
Thank you, Steve. Clearly, as we've discussed just now, we've seen a very sharp revision in market expectations around monetary policy, and Fed is clearly expected to be a lot less accommodative than before. And as a result, we've seen sharp increases in bond yields and decline in bond prices over the past 3 weeks. But if we analyze the prior Fed rate hiking cycles, what really stands out to us is that across most areas in bond markets, we see negative returns 3 months leading up to the first Fed rate hike. But more importantly, we see positive returns on an average 6 months after the first Fed rate hike. Now, why is that the case? Well, in most cases, markets tend to price Fed rate hikes for the next few years well in advance. And we've seen a similar story play out this year as markets have moved towards pricing in 4 rate hikes in 2022 versus one hike 6 months back. And hence, we think that the upward drag on yields from here on should be limited. But overall, we think that in the next few months, positioning in short maturity and higher yielding bond asset classes offers the best way to manage the potential downside risk as we lead up to the first Fed rate hike. So currently, we are overweight on developed market high yield as well as Asian dollar bonds, especially as we are starting to see signs of policy as well as regulatory easing around Chinese property sector.
That's actually a great segue for what I wanted to discuss next. So we saw weak Q4 economic data at the beginning of the week, Daniel. What does this mean for China equities? Obviously, Abhilash mentioned the regulatory easing as well from the property sector perspective, but what's the outlook in your opinion?
Actually, in terms of a 1 to 3 month horizon, the Chinese equities are looking relatively pretty good at this moment in time. So one of the reasons is because of the weakness in the US growth stocks at this moment in time. So there has been position unwinding, people powering back on the US growth stocks and short covering on the China growth stocks. So it's one positive factor. And the other phenomena that we're seeing is that there has been some policy easing in China. So earlier this week, there has been some unexpected rate cut on the policy loans, which shows that, in contrast to the US, which is restricting, China has beginning to ease. Okay, so that led to Hang Seng Index breaking above some important resistance level, for example, the 24,400 level. And we think that the Hang Seng Index in the short term could challenge around 25,800 level. Okay, so in the short term, it's looking pretty good. But in the longer term, China equities is still a core holding for us, means that it's likely to broadly perform in line with global equities, because we think that while the regulatory narrative has been moderating lately, we would like to see more clarity on the directional shift in policy in order to turn more constructive on China equities.
Okay, let's move on to currencies. So we are bearish the dollar in the second half of the year. But what about the first 6 months, Abhilash?
Thanks, Steve. So obviously, we've seen an interesting price move in the dollar. So it declined in the first 2 weeks of the year, and it's gained back about 1% in the past week or so. So at a broad level, in the near term, we see possibility of another small leg higher in the US dollar before it eventually starts its extended decline for the rest of the year. Now, we expect the dollar will peak when foreign investment flows into US asset markets slow meaningfully as non-US assets become increasingly attractive. And once the shift in flows and expectations start to favor Europe, which is possibly the last shoe to drop from a central bank tightening perspective, that's when we really think the dollar decline could begin for a sustainable period. Now, if you look at technicals for near-term indicators, which can help us identify trend reversals, we think that the DXY index faces resistance at just below 97 and around 98 levels, and right now we are at 95.7. However, for us, the key support lies at 94.5 level, which has survived its first test about a week back. And a sustained break below this level would certainly increase the probability of the dollar trend turning bearish on a more sustainable basis. In the meantime, we continue to like non-US dollar currencies such as Canadian dollar, Australian dollar, as well as New Zealand dollar.
Okay, so a related topic is the outlook for gold. So we do have a non-consensus bullish view on gold. Can you give a brief rationale for this view?
Sure. So, as you mentioned, gold remains one of our preferred asset classes within a multi-asset context. As we like gold's diversification value as well as inflation hedge characteristics. Now, the obvious concern is whether gold can rise despite higher bond yields. But if we go back to the fundamental drivers, what matters more for gold is the inflation-adjusted yield and not the headline yield. So if you think about inflation-adjusted yield, which is essentially the opportunity cost of owning gold, we don't think that they are going to rise significantly from here. So given our view of the Fed rate hikes, as well as the elevated long-term inflation expectations, we think that the inflation-adjusted yields should remain in the negative territory and capped around current levels. When we add to that the fact that we expect the dollar to weaken, we think that will be a tailwind for gold. And this should aid the recovery in physical markets, especially in emerging markets, which have usually been a strong floor provider for gold prices.
Okay, so maybe the final question to sort of throw out there. Obviously, Facebook's rebranding to Meta has obviously got people's attention on the Meta or Omniverse. I think there's obviously significant parallels between this and the crypto universe. So, obviously cryptocurrencies is often used on the metaverse, and obviously there's going to be a spawning of different available options for people. So maybe Abhi, just from your side, in terms of the cryptocurrencies, can you give a quick sense of your thoughts there?
Well, cryptocurrencies is a very broad space, and just as of yesterday, there are over 80 cryptocurrencies which have a market cap of 1 billion. So there are different drivers for each individual currencies. But I think if you look at them as a whole, despite their name, cryptocurrencies tend to trade similarly to risky assets such as equities as opposed to currencies. Now, we acknowledge that there are potential diversification benefits to owning cryptocurrencies, but we find little evidence of them functioning as safe havens, which seems to be a popular narrative. Obviously, in the last 6 to 12 months, we've seen increased institutional and retail investor interest in cryptocurrencies. But in our view, the central bank's push towards digital currencies and potential legislative reforms, which could limit the use of crypto assets, remain the biggest risks in our view. So, we would treat any exposure to cryptocurrencies as an option to significant potential upside, but also matched by a risk of complete degradation of capital. So, given their much higher volatility relative to other asset classes, we think that any exposure should be capped below 5%.
Yeah, on the regulatory front, I suppose we've seen some measures ranging from countries such as Russia through to Singapore in the past week or so. So that is going to be a major concern, I think, for this environment. I think the way I view this is that there will probably be some winners out there, but the chances of us picking the right ones is very challenging, which hence suggests that it's going to be capping exposure and treating it as almost play money rather than investing. Is probably the best way to go. So anyway, thank you both for joining me today. I would like to point everybody listening to the link for our weekly market view publication, Don't Fear the Fed, which will be coming out on Friday afternoon, which goes through more of the client questions than we had time to go through today. The link for this is in the podcast description. Also, look out for our Standard Chartered Wealth Insights page on LinkedIn, which also includes a lot of CIO office content from Standard Chartered Bank. In the meantime, thank you for joining us today. As always, please feel free to rate and review our podcast. Your feedback is very, very invaluable to us. And take care and stay safe.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.